Perfect. All right. So thank you everyone for joining this evening. I'm Michael Prescott. I'm the Chief Philanthropy Officer with Riverkeeper, and we're very excited to have one of our partners, Longwave Financial, joining us to give an overview of values-based investing and how you can figure out the best way to align your personal focus on sustainability with your investments. So without further ado, I'm happy to hand over to Nathan from Longwave.
Great. Thank you so much, Michael. And good evening, everybody. This format, you all can see me. I can't see you. So usually I depend on seeing everybody's nods and, that facial expression of tell me more. But Michael, I'll be depending on you for that kind of input. So my name is Nathan Munitz. Thank you for giving me and my colleague Brandon the opportunity to uh, share what we do with you today. Um, Brandon is our investment guru, and he'll be, I would say, the meat and potatoes of today's presentation. Um, and where should I start? Well, first of all, some of you may know us. We've collaborated with Riverkeeper on the whale watching event, so you might have seen some of our faces there. And if you haven't had a chance to take that tour, it's incredible. There's dozens of whales and dolphins in New York Harbor these days, so please go out to that next time that's offered. Um, so um, my uh, my company is very much aligned with the type of work that Riverkeeper does, in the sense that we have a very similar mission, but a different approach. Um, our focus, like Riverkeepers, is protecting the environment and social good. So the company that I run helps people align their investments with their money um, to protect what we have in the world around us, and also to prepare a world that may be different in the future. And we do this through an investment lens. Um, so we've done this presentation around aligning your money with your values. With Third Act, we've presented this to faith-based organizations, and this is really um, uh, connected to something that we all care about very, very much. But when it comes to investing, maybe not something that we think of as a lever that we have for change. Um, so this picture that you see, the moral arc won't bend itself. This is actually from a rally in a town near me, Hastings on the Hudson. I think this was from No Kings rally. And that's really at the heart of what we're trying to do. We have primarily two ways that we can influence the world. We can vote, number one, and we also can vote with our resources. Very often, when it comes to voting with our resources, that means um, philanthropy, and certainly Riverkeeper is a fantastic cause that we all care about very much. Um, but our money also has a tremendous impact. And that's really what we're going to be exploring today. Um, so um, we have so much influence, untapped influence, when it comes to our money, through where we buy insurance, where we do our banking, and certainly with our investments. Um, let's think about, in a very simple way, banking as an example. When we deposit money with a bank, we have no say in how that bank uses our money. And so our colleague Michael Richardson at Third Act, he has a great seminar around how to move money from the major banks to community institutions that have direct positive influence in our communities. Very similar to his seminar on insurance. Insurance companies take our premiums. Some of it is used to pay out claims, but the rest they put into bonds and other securities, and we have absolutely no control over what they do with that. Um, but our investments are a place that we actually have very, very direct control, and you might say impact. Um, so when we talk about impact, um, where when we are investing, is that money going into a financial institution? What is that institution doing with it? What funds are they holding? What investments do those funds hold? Those are all things that we can dictate. But again, it's just not something that we necessarily think about. And what I like to, we can move to the next slide, Brandon. What I like to think about when I compare being intentional with investing, I really think about it um, like eating organic. Um, I'm 50 years old, and I remember in the 90s, if you were even thinking about organic food, you were in the vast minority. It wasn't even something that was on people's radar. Um, People checked their labels, but it just wasn't a concept. And we think about the work that we do in a very, very similar way. That essentially what we're asking people to do is check the labels on their investing, on their investments. What's in there? Where's your money going? What bank is that with? It really makes a huge difference, and Brandon's going to talk about that in a second. So I just want I like to talk about our mission. And before I hand this off to Brandon, it really has three pillars. The first part of our mission is just to get the word out that, hey, this exists, that you can invest according to your values. That this is an option for everybody if they would consider it. The second thought that I want to share is this is really a declaration that you don't have to give up returns to invest in this way. There's just this stigma that, and again, it's really tied into our political environment and so much more that you have to accept lower investment returns to do good with your money. And that's just absolutely not true. You can have a great banking, insurance, investment experience while still doing good with your money. And the third thought that I want to share is that you can do this authentically. So there's all these, Brandon, if we can jump to the next slide, there's all these roadblocks, it seems, to values-based investing. And I would say greenwashing is probably the biggest thing that we run into. There's just this skepticism that how do I know that for instance, the food that I'm eating is really the good food that I'm expecting, and there's a similar skepticism in our world. And so part of what Brandon's going to talk about is the types of ways that you can be on the lookout for greenwashing when you approach your bank or your financial advisor or your 401k company. So, Brandon, if we could just go to the next slide. And so before we really dive in, what I want to just point out is the different layers when it comes to our money. We're actually really pretty separated from how our money is invested. So most of us have a 401k or an IRA through our work. And though that 401k or that IRA is held at a bank or a financial institution, um, is that financial institution itself, like let's say a JP Morgan Chase, aligned with our values? Um, Now, the bank or the financial institution will suggest or offer different mutual funds. And how are those mutual funds aligned? What's their philosophy in terms of how they pick companies? And then finally, those mutual fund companies own a basket of individual stocks. And what are they picking? Are they picking companies that are doing good or trying to do good, or are they just throwing their arms wide open and say, we're just going to invest in everything? Or are they actively investing in things that we would consider not aligned with our values, such as oil exploration companies, weapons manufacturers, private prisons, and these do not represent a huge part of the market. It really wouldn't take a lot to eliminate these from a mutual fund or a portfolio. We're typically only talking about anywhere from 8 to 12% of a portfolio. So this doesn't have to be a radical change, but it does take a little bit of intentionality, just like when we turn the can of peas around and see what's the sugar content, what's the sodium content. This is the same idea. So with that introduction, Brandon, all yours.
Yeah, great. Thanks for kind of opening it up a bit. What I'm aiming to give you from going forward is a bit of a toolkit or the language to kind of look into this and understand how you can align your values with your money. What are kind of some of the terms out there, how you can frame your view and know what to look for. So to start, there's kind of three different paths that we've identified here at Longwave and a bunch of other firms, kind of industry standard way of looking at how funds can approach ESG or values aligned management. And the first and foremost, the one that kind of comes to mind the most for people, or generally they're first introduced to, is divestment. Divestment really kind of began during the apartheid movement, although people have been doing it for a long time. Even the first Quakers that moved into the United States, they would not invest in gambling and activities that didn't align with their religion. So there's always been kind of religious-based exemptions for investment. But really during apartheid in the 1970s, then you started to have financial institutions make moral kind of stands on divestment against poor practices such as slavery or segregation and divesting from places that participated in that. And so then you got a movement towards divestment over poor practices that they thought would hurt financial performance. You don't have efficient markets when you are participating in things like apartheid. And it's also universities didn't want to be morally culpable to funding those type of activities. So the divestment movement really got off the ground there. Divesting is generally, as I said, the most common way people view values-based investing. But then you have enhance and kind of over weighting, things that you do want to be exposed to. And that kind of framework is going to be a little bit more active in nature. You're trying to get ahead of the ball a little bit, investing in things that you think are going to benefit from societal trends. And lastly is kind of impact. And the impact framework is maybe you might have to give up return, maybe not. It's really about having direct impact to the societal good with your investment dollars, not necessarily on an exchange or using a middleman, but having something like direct loans or those type of investment vehicles. So to kind of, as I said, to kind of go into divestment a little bit more, it really started with kind of the apartheid movement. Some really common things that you'll see screened out in a divestment framework for funds are things called sin stocks. And those will be alcohol, gambling, tobacco, private prisons, and weapons. So mo almost every fund that says that they're divestment oriented are going to screen out those type of activities. However, there are many different frame lenses to kind of view divestment. And so you have to be really careful when you're selecting a fund because it could be a religious-based exemption framework, which means that you could be excluding things like stem cell research and things that don't align with a particular faith-based organization. It could be a progressive-oriented divestment framework, or it can be a conservative-oriented one. And the name on the fund will not always tell you the minutia or the details of how they view divestment. That takes a little bit more research and know-how on how to read through different policy statements within the fund itself. And then with Enhance, as I said, it tends to be more active. You may only own a few dozen companies in a fund that is attempting to kind of get a benefit from societal trends and be more active in owning companies that they think are going to benefit from things like the transition from fossil fuels to clean energy. This could look like a thematic energy fund that is investing in green energy. That could be an example of an enhanced or engaged fund. They believe the thesis of this fund is that uh, society will reward better behavior from a moral perspective. And this has been shown to be somewhat true in the past for some specific examples. Things like Patagonia has done tremendously well. They're not always the cheapest, but people like their mission and what they do and tend to support them. Most consumers actually want to align their personal preferences with their purchases. That's why most companies actually exist. Costco is a really good example of this as well. They treat their employees really, really well. It's pretty widely known at this point, and that's led to really low employee turnover, actually only about 9% annually, which is the lowest in their industry. And the biggest expense of any company is wages and loss of productivity from rehires. And so Costco has done tremendously well just by treating their community well and their employees tremendously well. And so that has led to really good results for Costco over the last decade or so. And so that's an example of maybe overweighting a company that you think is doing a good job with their employees or their community and potentially benefiting from it. Some other examples are like Subaru has a big kind of push towards community engagement and supporting charities and things like that. So people will want to overweight companies like that. Um, Lastly, the kind of the third framework that I introduced is impact investing. This is really having either maybe more of an altruistic lens or direct connection to their investment. As I said, really good examples of this is like banking access funds, so microfinance, loans to rural areas or to communities that do not have traditional banking. Think of like really rural parts of Africa and South America where there isn't traditional kind of financial institutions in place. And so people cannot get loans, which are really the kind of the how you motivate a lot of capital formation uh, in the world. And so when you don't have access to that, it's pretty difficult to grow businesses. You have to bootstrap everything. Uh, and a lot of these places only need loans as low as like $200, we've seen examples of, and no bank is interested in that. But these microfinance companies will gather up some money from investors, go into these areas, and provide a bunch of these small loans, willing to do a little bit more of the work. Now, that may lead to slightly lower returns, but now you're going to have direct impact to and direct results, theoretically, to the end good that you are participating in. But not all of them necessarily give up returns. There's impact investing could also be direct investment in green energy, which has done tremendously well, things like solar and hooking up the grid. Two-way grid is a really big thing right now. So providing loans to municipalities around the country that need to make what was our entire grid was one way, so sending power from the power factory to homes, now making them two-way because people have solar on their homes and need to be able to send power back and need to be able to have that transmission back and forth. That is a complete reconstruction of our entire grid and takes an immense amount of capital that the government is not going to put up, and therefore private citizens can do so at a market rate of return. So that's another example of how you can have direct impact with potentially market-like returns. And kind of a fun fact there, 90% of all new energy projects are in the United States, even currently in the year 2026, are renewables. So that's reassuring going forward. And now we get into this concept of engagement. Engagement is kind of an umbrella in which encompasses all of these different tactics for investing. And none of these are necessarily exclusionary. You could have both some divestment and some enhancement and some impact all in a cohesive strategy. But engagement is kind of an overarching lens to view all of this. If you own a stock or a company of a company, you are theoretically an owner of that company, which gives you rights in terms of your voice. And this is where we think a lot of the difference can be made at a corporate level. And this is where a lot of the effort goes into actually aligning your values with your investments. If you divest from a company, you're in some ways kind of removing your voice. Now, that can be beneficial because it shows management that people are no longer interested in what you're doing, but it also doesn't allow you to go and tell the board or the management that, hey, we want you to change your business practices. But if you own the company and you vote and you educate, you can actually potentially make some pretty measurable differences at companies. And we've seen a lot of really good examples of this. So we think engagement is really the lens in which you can make differences at the company level. A really good example of this was Walmart, and Walmart used to be one of the largest purveyors of firearms in the country. And after a couple tragic events, a bunch of shareholders and fund companies went to them and said, "Hey, what if in the next event a weapon from your store ends up there? Is it worth it to you from how much money you make on selling firearms for that to be a PR disaster and ruin the reputation of your company? And like if one employee mishandles anything, this could be devastating to the entire business for what is a pretty small portion of your entire revenue." And Walmart considered this shareholder proposal and actually removed firearms from their stores to this day. They did the same exact thing with Kroger, and there are dozens and dozens of really interesting examples of shareholders going and making changes at companies. A lot of business grassroots efforts come directly from shareholders. And so it really is an important aspect that you are engaged and use your voice to make changes at these companies. But that kind of takes me to the next point, which is this is why it matters so much what fund provider or person you partner with to construct your portfolio matters, because there are funds that are engaged and funds that are not engaged. And most of the big names that a lot of people know are no longer really engaging on these topics. Names like Vanguard, State Street, BlackRock, iShares, they no longer really engage on values-based, environmental, social, and governance-based issues. And they're fairly open about it as well. They used to when it was politically advantageous to them, and it was kind of the hot thing for everyone to be doing is to be engaged socially with their investments. But once they got a little bit of political pushback, most of those companies kind of left the marketplace of advocating for change at companies using their shareholder vote. And so you really need to be aware of what companies you're selecting to manage your money, because you could be completely getting rid of your voice, which we think is most of the challenge in aligning your money with your values. And yeah, so really, most of in the name on the fund will not give away whether they are engaged or not. There are many funds that label themselves as ESG or green, or sustainable or responsible even, but they are not actively engaging in terms of shareholder proposals and proxy voting in a values-based way. So it's a kind of nuanced level in which you have to get into to see if they are doing that. And it's also may not be completely knowable by looking on their website. This may just be something you have to look into the proxy records on kind of different databases such as Morningstar, and look at things like Globe scores from companies like Sustainalytics and other third-party platforms. We, being financial advisors, and asset managers have a lot of third-party data that allows us to see this, but it's important that we kind of take that level of granularity because, again, we think it's most of the kind of fight in terms of changing uh, companies and investments. So, what are kind of the next steps? I kind of threw a lot out there. There is kind of three different ways you can look at how funds manage, uh, and you kind of have to figure out what resonates with you the most. Now, in most cases, you're going to have a blend of the three, but where is it appropriate to implement across your financial picture? How much do you want to lean into each one? Everyone has different preferences. What values do you want expressed? These are all different things that you can kind of work with when creating your financial portfolio. And you can kind of start doing some research. There's a lot of really good organizations that we're partnered with that kind of will sort out what is authentic, what is not. The United States Sustainable Investment Forum is a good place to go that has a lot of research on that. Uh, Sustainalytics, as I mentioned, which is owned by Morningstar, they have globe scores. So if you type in a fund to Morningstar, you'll see some globes there, 1 out of 5. Anything above a 3 is pretty solid. And yeah, at the end of the day, this is a lot to kind of learn and take in. And so you might have to determine, do you need an advisor to help you do some of this research and figure out if you are invested in the way that you want to be, or anything like that. So, yeah.
One other thing that we talk about, maybe it's a little out of the scope of today's presentation, but we run into this a lot, is a lot of folks that we talk to are really focused on removing fossil fuels from their portfolios. They care about social, and they care about governance, but uh, a lot of people see values-based investing through the fossil fuel lens. And that's, I think if we zero in just on that lens by itself, like the E in the ESG, when people talk about this space, the environment and how fossil fuels um, can be looked at through a values-aligned investing lens. That's something that we get a lot of questions on. And even that is very nuanced. On the surface, somebody might say, well, I want to move away from fossil fuels, or I don't want to have any exposure to fossil fuels in my portfolio. And There are resources, there's websites that identify funds that claim to be fossil fuel free. So, for instance, fossilfuelfree.org is a resource that many people look into. But even something as simple as that really does require more digging. So we also ask, after asking, what kind of values-based investor are you? Are you more focused on divestment? Are you thinking about future opportunities, or do you want to have more of a philanthropic impact? There's sort of a similar approach when it comes to fossil fuel free. What do you care? What do you really care about when it comes to fossil fuels? Do you want to eliminate all exposure to fossil fuel developers in the industry, or what about companies that support the fossil fuel industry and create pipes for the fossil fuel industry, or companies that transport fossil fuels? Should those companies be divested from? And again, there's different scoring mechanisms for funds that claim to be fossil fuel but free, but what level? Is it primary? Is it secondary? Is it tertiary? Some people are very, very passionate around this space, and it's worthwhile asking yourself or asking a financial institution or your financial advisor. Tell me more about, for instance, fossil fuel free investing. One thing that we talk about really touches on the engagement point that Brandon made a second ago. Why is that important? Well, the way we think about it is if you go into your portfolio and you sell all of your Exxon stock, Exxon is a $500 billion company. They don't really care if a bunch of us sell our Exxon stock. And in fact, they're probably happy that we do, because then we won't show up at their board meetings and vote their proxies, and we're just less of a headache for them. It really is not going to move the market. On the other hand, if we invest into a green energy company, for instance, that's actually not going to make that much of a difference either. We may benefit from it, but the green energy company, they might see their stock price go up slightly, but really we're just buying shares from somebody else that wants to sell them. Where we really make an impact is in the engagement. So, for instance, sometimes we may want to invest in a dirty company or a utility that is small enough where we actually can make a difference as through our shareholder advocacy, by partnering with funds that are showing up to board meetings and writing shareholder proposals, as Brandon outlined with Walmart, for instance. And in that case, a fund that is focused on engagement, that is focused on changing companies, may get a very bad score from fossilfuelfree.org, but is actually in the vanguard of pushing for change. A great example is a company called NextEra, who was in the process of building the country's largest solar farm in Nevada before their contract was or their license was revoked by the Trump administration. NextEra had been a traditional energy producer for many years, but over the last few years, they've started to shift towards renewables, where today, I believe something like 45 or 55% of their energy production is renewables. So that's the type of company that if you're just getting rid of all fossil fuel exposure, you are not supporting a company like NextEra with your investment dollars and with your voice um, through them as a shareholder with your advocacy. But we see that they're not perfect. Maybe they're not moving as quickly as we might want. But again, that's where the shareholder advocacy comes in. So just wanted to spotlight one specific area of values-based investing, just how nuanced it could be when you really dig below the surface of how our investment dollars can actually be a force for good. Um, so with the time we have left, Michael, I'll hand it off to you if we've had some questions pop up for us.
Yeah, thank you for that. And just a reminder to everyone to put any questions you have in the Q&A box. I did get two questions sent to me on the side. One, I think you actually kind of just addressed, Nathan, which is at what point, what is the tipping point from trying to be a shareholder that advocates within the company to just deciding to divest? And is there kind of a mechanism or system people can use to determine when it's the right time to divest rather than try to take action? So you kind
Mhm.
of touched on that, but if you had anything else around that question, feel free to add.
Yeah, it's something that the fund companies that we partner with think about a lot. Brandon, do you wanna
Yeah.
address that?
Yeah, there's a pretty specific framework for it on when they decide to disengage the partners that we have specifically. It's it's somewhat nuanced. So basically, they will attempt multiple times for even up to a couple years to engage with a company, but if they make no headwinds really with any changes, if they get denied multiple times, they can't get grassroots support with other shareholders, they will eventually divest. We've seen it take as long as 2 years. They did it with Tesla for a while. One of our fund partners continued to engage with Tesla, and Tesla had fantastic sustainability scores, but really poor governance scores with lawsuits and the way they were treating some employees and things. And they tried to clean up the governance score. They were not getting any feedback on that. And then they would quietly kind of leave the position in the fund. So, in this kind of brings up a bigger point. There is no individual investor that really has the time or the knowledge to go through the thousands of holdings they may have and then the hundreds of votes for every individual company that they own, and be educated on every one and be able to vote these things. And that's why these fund companies and partners that we have are very important, finding the right one, but making sure they have a research team that knows what they are doing so that they are nuanced enough to know when it is appropriate to disengage and divest. Because it's a difficult decision to make because then you are potentially increasing your tracking from a benchmark or something like that, or you have to replace it with another company and decide which one is better to own. So yeah, it's really having the right partner and knowing you're on the right team that has the right knowledge and due diligence and have a track record of doing it appropriately in the past. Now, as I said, some mainstream providers like iShares and things, they basically won't make decisions based on this. Uh, they will basically just own them and continue and not engage, or it'll just not hit a screen for them, and they'll just divest. It's just an algorithm to them. There isn't engagement and nuance like there is with some other investment providers.
Thank you for that. And then that's a good segue into the second question, which is for people who are interested in continuing the conversation with Longwave or how they might potentially work with Longwave. What does the process look like for that?
Yeah, I would, our website is longwavefinancial.com. I'm the founder, and we have multiple financial advisors. We have a director of sustainability. I would say go on our website, see who you might want to talk to, whether it's myself or Brandon, or Lane, our director of sustainability, and just start with a conversation. Where even if we can give you some good ideas or good direction, we're all mission aligned. So, sometimes we just, talk to a person and we say, look, maybe you just don't need us today. Here's three or four things you can do right now with your portfolio. And then sometimes we run into more complex situations that really might require more in-depth exploration. And sometimes people just want proof. They want proof that their money has an impact. So our fund partners issue annual reports of the engagement that they've had with specific companies. And I really like the example that Brandon brought up with Tesla. A lot of people thought that values line companies disengaged with Tesla because of the political activities, which, of course, that's a huge part of it. But it really pivoted on, as Brandon said, how they were treating employees, but also executive compensation. You might have seen that Elon Musk won, $1 trillion compensation package from the board of directors, and the lens that we see a lot of the divestment that we do is really a risk lens. And so when it seems that a CEO or an executive or a board's interests are not aligned with shareholders, that's a risk factor. Brandon threw out a term earlier, ESG. And ESG, all of a sudden in the last few years, has become a bad word, just like DEI. It's just, these are good things that just became politicized and became political weapons. But really, ESG is simply, it stands for environmental, social, and governance, but it's just a framework to analyze risks to companies that are not apparent in their balance sheets. Balance sheets are basically like, what's your profit? What's your revenue? How quickly are those growing? But the ESG framework looks at things like, is the CEO's compensation misaligned? Is are they polluters, which will probably they will probably be dinged against in the future? Are they are they moving towards the future of renewable energy, or are they stuck in the past? If you're an investor just thinking about returns, you think about the future, well, duh, the future is renewables. It's inevitable, and it's good business. And so an ESG framework helps identify those companies that are moving um, into the future or stuck in the past. Just ripping a good example from the headlines today is Purdue Pharma, which sold OxyContin and made the Sackler family incredibly wealthy. Well, they've had to give a lot of that back. They just had an $8 billion settlement. And so in their case, they were a private company, but an ESG framework uh, might have, from shareholders, might have said, hey, your products are killing hundreds of thousands of people. Maybe you guys should change your practices. Not only would that have saved lives, it would have had a social good, the S in the ESG. It actually would have been good for the company and it would have been good for the shareholders. So we don't just see this as a force for just strictly impact, but also a really sound investment thesis. If a company's doing the right thing, it will probably be more successful. So just wanted to add that on.
Excellent. Well, I think that is all the questions for today. But thank you, Nathan and Brandon, so much for your time and sharing your expertise. And thank you all for joining. We will be sending out a recording of this, but really appreciate your time, support of Riverkeeper, and hope you all have a great evening.
Thank you, Michael.
Bye,
Thank you.
Thanks.
everyone.
Thanks, everyone. Have a great evening. Bye bye.